Right now, today second session on financial reporting issues. Last week we just started the session, the syllabus, and accordingly, if you can remember, we discussed about small introduction for contemporary accounting issues as well as financial reporting issues. So, if you can remember, with the research article, I told you some broad areas that we need to open our eyes relating to some issues in accounting. Also, now we are going to discuss some micro level issues in financial reporting, right? So then at the same time we discussed human resource accounting last week, right? You didn't come last week. No? Yes, hope you have followed down lectures, right? So one thing already discussed, how to recognize human assets into books of accounts. We learned different models, and we realized that it is not possible to recognize human assets as an asset into books of accounts due to some reasons. So that's about last week work. Now today we are going for another technical session actually. So then we have another major 3 areas to be discussing according to the syllabus. I am going to complete those 3 first. One is how to recognize share-based transactions in books of accounts. Another one is how to recognize different types of employment benefits. And other one is financial instruments. So those are the major 3 things we are going to touch within next couple of weeks. Today one and the next week. Today I am going to plan actually IFRS 2. I know I don't want to use more than 1.5 hours, but let's see what we can do. And in the second part, I will discuss something about employee benefits. So therefore, today I am going to cover 2 things, at least 1.5. So I will discuss about IFRS 2 share-based payment, and I can go up to certain level. I can complete 50% of employee benefits today. Right? Basically. Right. So what is the share-based payment? Now this is kind of actually a motivational factor which is given by employers to top level employees mostly. Maybe CEOs, board of directors, something like that. Right? And mostly this kind of offers are given for top level or senior level employees in organization. Take simple example like this. Let's assume now these are my employees, right, in organization. Now I can, let's assume all are senior people in the organization. To encourage you and to retain you in my business over next 3 years or maybe 5 years, I can give you a package. So something like this, like let's say now anyway you are earning now salaries and wages in the company. In addition to that, I can tell, now if you stay with me for next 3 years or maybe 5 years, and if you can increase my share price in the market, let's assume I am a listed company, right? Listed company. If you can increase the share price, let's say by 25%, you are allowed to get a commission from the increment of share price. Let's say now today's share price is, let's assume now today's share price is 20, right? So then you join today, and I ask you to stay for next 4 years or 5 years, let's say 5 years, or maybe number of years, right? At the end of the 5th year, my share price should be increased by 20%. Then it means this should be how much now here? It should be 24. If you can increase my share price from 20 to 24 over next 4 years, I will give you a commission on, let's say, on 1000 shares. 1000 shares, or let's say 100 shares. So what is your commission now? If you need to, now let's say you have increased 20 to 24, that is minimum target. You have to increase share price by 20%, 20% from the original price. Now today's price is 20, should be increased by 20%, and you have to stay with me for next 5 years. Look at the conditions. What are those conditions? First thing, you have to stay with me for next 5 years, and also you have to increase your share price or market price per share by 20%. It means there should be 24 at least to get the commission of 100 shares. Then what is your commission? Let's say 100 into, you will get let's say 80% commission. 80% commission on this. Then what is your commission if you achieve this target? Let's say you stayed with me for next 5 years and you have increased your share price to 25, let's say. 25 means you have achieved the target. What is your commission? 25 into 100 into 80%. All individual senior people will get a commission by cash. What is your commission? 25 into 100 into 80%. 25 into 100 means 2500, 100, it is 2500. No, how much? Yeah, 2,500. 2,500 into 80% will be your commission, right? So then, how do you increase the share price of a company usually? How can you increase it? What are the ways of doing it? Now, if you are working as now, let's say, if you need to increase share price of Sathaksran, it is not a registered one, no, listed one, no. Anyway, now there are some positive budget proposals also. Yeah, no. We are going to open some Sathaksran outlets. What is going there? There are two things. Lanka Sathaksran. Which one? Sathaksran? Lanka Sathaksran. Oh, which one they are going to expand? Private one. Private one. But government affiliated, is it? Not your one. You are going to shut down your one. The other one is open, is it? Maybe. Right. Anyway, let's assume if you are a registered entity, you need to increase your share price. What you need to do? How share price usually increase? Maybe different factors are affecting. But one of the key factor is company performance. One of the key factor. We can't say exactly as a result of profit your share price increase, but usually there is a positive correlation. If any company is performing well, what happens? Their market price should be increased. We have certain doubts whether it happens actually. But according to the performance of the theory is what it says, if company performance increase, what happens other side? Market price should be increased. Why? Company performance increase means there will be big demand for those shares in the market. As a result of that, market price per share will be increased. Right? So usually we say there is positive correlation between the market price per share and the performance. Performance means simply the amount of money you earn, the profit you earn. That is positive. But there are some other factors as well. Now in our country, probably due to some budget condition. Even you see now there is market fluctuation when the new president for the United States appointed. When it happens, what happens? Then our market prices, the market prices of shares will be fluctuated. It means there are some other factors, but one condition that we agree, if any company is increasing their performance, or if performance are well, market price should be increased. And what you have to do to increase from 20 to 24, you have to perform well in your company. So then you have to bring new ideas to the company. You have to contribute, or you have to work maximum towards the company. You have to generate enough profits for the company. You have to get maximum out of your subordinates for the company. So then you have to do kind of creative things in your company. You have to introduce value-added activities to the company. As a result of all these, what happens? Your company performance will be increased. If you sleep over next 5 years, what happens? It comes down obviously. Look, it is kind of target-oriented payment scheme. If you work hard, what happens? You can increase your payment by yourself, in addition to your salaries and wages that you take monthly. Understand? So let's say now, if you increase share price to 25, you get a commission. Anyway, if you can't increase up to 24, you are not eligible to get this benefit. It's another fact. Also now, let's say if you can increase it to up to 30, your commission will be further increased. Why? If you increase it to 24, anyway you get a commission, certain amount. If you go beyond that, what happens? You can increase your kind of amount you are expecting to get at the end of which year? 5th year. Now, what is this? Now, let's say I have only 5 employees. I have 5 employees. Accordingly, now at the end of the 5th year, my share price, let's assume it's 25. Then 25 into 5, 25 into 5 into 100. It's 12,500. 12,500, out of that I said I pay only 80% commission. Only for 100 shares. That's kind of package that I have given. Then my commission will be, it's around 10,000. If the condition is like this, I have to pay 10,000 at the end of 5th year. Sometime you will resign at the end of the 5th year after achieving this. So therefore, what should be the accounting treatment for this 10,000 at the end of 5th year? Probably I will pay it by cash at the beginning of 6th year. Understand? How much? 10,000 for these 5 employees. Understood? Now, when do you recognize this expense? Is it at the end of 5th year or beginning of 6th year, or in the year of fifth year or over the 5 years. When should I recognize this expense relating to kind of benefit given by employer to employee? I pay a commission to you. Understand? I pay by cash. So then it is kind of expense. I have given a promise at the beginning of the 5th year. Promise is given somewhere here. Actually, we are going to account for these different types of promises given by employer to employee. Actually, this week and next week, that's what we do. A lot of promises are given, right? So then we say now this kind of what is called benefits will be given if you stay for this number of years. Now our pension fund also going to be changed. Don't know what happens from the budget proposals. Now, as accounting postgraduate degree holders, you should be able to open your eyes for these budget highlights. That's important. I think you learn it in taxation probably. There are some tax implications and ways as well as others. What's going to be happen for the pension for government servants? You don't know. It will be converted into a kind of participative fund. Actually, in our case, we have UPF, University Provident Fund, and a pension scheme. We also contribute some amount for the pension. Based on the fund, we do accounting for that thing next week, and employee benefits, IS 19. So then I provide 8%, university provide me, sorry, I provide 7%, university will provide 8%, all together 15% will be sent to pension fund. Based on fund available there, they will pay me a pension after retirement. For government servants, you don't contribute. Government servants will not contribute for the pension fund. Now, they are going to structure like that. Thereafter, government servants also should contribute something to the pension. Anyway, it will happen. So then, how should I recognize this expense? When should I recognize this expense? Yes? End of the 5 years. When? End of the 5th year. Do you learn something called revenue? Revenue standard, did we discuss? Yes, no? Last semester? Yes, right? How should I recognize this expense? Let's assume I am employer, you are employees. In my hand, it's an expense. How do I recognize it? When it is realized. Expenses are incurred, not realized. So then when it is incurred when? At the end of 5th year. Therefore, you should recognize it at the end of 5th year. Is it? When should I recognize this 10,000 as an expense? That's my question. At the time of promise is given? At the time of amount is paid? Or over the period? Who is online today? Only 3 people. Can you hear me? You all are? Huh? Your names? You are online? Chiran anyway there. My name? Who is PSN? You. And you. And you. Yes, no, offline. Not offline, I think. It's not offline away, I think. That icon. Right, anyway, no people online. It's a lone weekend. No? Then no people come in for the classes. So better thing, you have to negotiate with the coordinators to cancel these classes. Right? If people are not coming, then tomorrow will be worst case. Next week because of the conference, no? So we will not able to have classes. Anyway, we have classes on Sundays. We do. Right? Not here, the other classes. Right, then, so then how to recognize? Can you remember something called matching concept? What is matching concept? Matching concept, it was learned with Professor Jayamahan within first set of weeks in Unit 1 accounting. What is matching? Matching concept done නැතුව මේ IFRS 2 ගන්නලා වැඩක් නැහැ. So we now for this week and next week, it is a concept we need to use everywhere. Matching. What is matching? That's how we do. Now you do account in masters, but you don't know what is matching concept. මටත් ලැජ්ජයි ඇත්තගෙන අත එක පැත්තකින්. Yes. Matching means we need to match income and expenses. If you recognize any income, relevant expenditure should be recognized. That's what we call matching. In income statement, right hand side or the credit side, we take income. If you recognize any type of income, relevant cost should be recognized into the debit side. So that's what we call matching concept, right? If you comply with matching, what do you think? If you pay this expense somewhere here, expense incurred here, when do you produce revenue related to this promise? It is over the period. You produce revenue for the company to increase your share price over this period, but the payment will be given at the end of this period, somewhere here. Understand? On the other hand, if the promise is given somewhere here, the initial level of expenses arise at the beginning of the period, but you can't recognize it there as an expense. Why? The income is generated as a result of the promise over this period. So therefore, to comply with matching, what you need to do? You are not allowed to recognize expense on this point of time, at the time of promise is given. Why? Promise is there, but the income is not there. You are not allowed to recognize expense at the end of 5th year. Why? Expense is there, income is not there. Therefore, income is where? Income is generated over these number of years. Therefore, this 10,000 in my example expense should be recognized over that how many years? 1, 2, 3, 4, 4 years, so 5 years, at a number of years. So that is the base concept inside this IFRS 2. There are some arguments actually inside this. There are some arguments, that's why we take this thing under financial reporting issues. Some people argue, why do you recognize like this? Is it an expense really? So if I change the facts now, previously what I told you, at the end of the 4th year, I'll give you cash as a commission to recognize or compensate your performance you contributed to the company over this number of years. Anyway, let's assume based on the condition, I agree to pay you 100,000 salary per month. In addition to that, what I gave you, I said, if you can increase my share price, market share price over like next 4 years by 20%, you are allowed to get a commission for 100 shares. For 100 shares means number of shares. 100 into share price on that particular day into 80% will be your commission. Then if I expect him to retire or resign from the business at the end of the 5th year, at the time of retiring, you can take salaries and wages over 4 years. In addition to that, that commission at the time of retirement. It's kind of motivational factor. We call it giving a carrot. Right now, as a result of what happens now? When you work for the company, you know, anyway, I get salary. At the same time, if you can expand your company performance, what happens? Your commission will be increased. It depends on your performance. Let's say if you increase this share price by 50%, then your price will be 30. Based on 30, what happens? Your commission will be paid. It means if you can perform well, what happens? Your share price will be increased. Based on that, your commission will be increased. Now the question will come. I'll come to another point. I'm going to change facts now. My conditions, again, these are my employees. My condition at the time of recruitment, I say, right, you stay with me for next 4 years according to this example. And if you can increase my share price from, let's say, 20%, by 20%, it means now it is 20 again, same kind of 24. I'll give you 100 shares for each of you free of charge. I give 100 shares free of charge to everybody. Now what happens? What is your benefit? You work for the company over these 4 years, you get salaries and wages as usual. In addition to that, what you can get? You can get 100 shares from the company free of charge at the end of 4 years, or 4 years, so 4 years or 5th year. Here 4 years now, at the end of 4 years. So then, if you can increase the share price in the market, what happens? You can take shares from the company, go to the market and sell. Then you can have what? A capital gain. Let's say now if you can increase share price from 20 to 24, you can go to market and sell that share, 100 shares in the market for 24, then you can have money 2,400. If you can increase your share price to 30, what happens? Increase it to 30, then your gain will be 30 into 100. Look, it means based on your performance, your value will be increased again. Now how can we, again what's the condition? I told you matching concept. Based on matching concept, that amount of what is called revenue to employee, cost to employer should be recognized over this number of years to comply with matching. Why? Because of the promise, every time you try to produce extra. Why? If you work extra, if you perform, your commission will be, it will be increased. It's kind of indirect kind of motivation given to employee by employers. Now, if I ask you to recognize this, whatever the amount over this period, what are the questions in your mind to do so? What are the questions? You teach IFRS 2, I don't want to use any slide. Already I have done 50% of this. Thereafter only calculation, only questions you need to take thereafter. Now what are the questions in your mind? If I ask you to recognize, let's say now you are working as an accountant, no? Accountant. Nobody working as an accountant. Accountant, only accountant. Yes, right. Let's say I ask you to recognize this, whatever the value, as an expense over first 4 years or the service period we call it. What are the problems that you encounter in this case? මෙහෙම කිව්වොත් එහෙනම් මොකද්ද පළවෙනියෙන් හිතෙන්නේ? කීප කාට ගහන්න දෙනවා ඉස්සෙල්ලා එහෙම. මෙහෙම. So what are the questions in your mind? So that's what we are going to target in IFRS 2 thereafter. Yes? What are the questions in your mind? Now if you are going to recognize this amount which is to be paid, we don't know even amount, it's also a question. Amount at the end of 5th year, or at the end of 4th year, over 4 years. Amount will be paid, certain amount will be paid by employer to employee, or shares will be given, number of shares will be given by employer to employee at the end of 4th year. But it should be recognized as expense over 4 years. Now if I say so, what are the questions in your mind? First question, how much will be the benefit given by employer to employee? I just said that it will be, hypothetically I told, it is 25 and 24, or whatever the value. But at the end of the first year, you need to do this adjustment. At the end of the first year, how do you know the value, possible value at the end of 5th year? It's kind of question. Understand? So now that thing is in your mind. One thing, what is possible amount? Right, that's one thing. What else? Yes, second question. Now look, we pay this amount at the end of 4th year or 5th year, anyway after a certain number of years. There is time value of money factor here. Right? So it's kind of question, another question we have in our mind. Another question is, let's say if I say like this, I give 100 shares to you at the end of 5th year if you achieve the target. I give shares. Is there any expense to me as employer? I give 100 shares to you. 100 new shares. I give each of you 100 new shares at the end of the 4th year if you achieve the target. Is there any outflow to me as company? Is there any expense to me? I just give 100 shares. Then you will go to market and sell it. You go to market and sell it and get a gain. Is there any cost to me to recognize something as an expense? on the question. I didn't pay you cash. In my first example, I told yes, it is paid by cash. Then yes, it is true. I have an what is called expense. In the second case, I said I give you only shares. Then you go to market and earn again. It's not from the business, no? From somebody else, you can sell your shares and get cash. Is any expense to me? Can you hear now? Right, okay. Right, now we were talking about problems if you are going to recognize like this. I told you 2 problems and 3 problems I told you. We have a question whether we have any kind of expense related to this kind of transaction. There may be some other questions we will discuss later. Now anyway, you can understand what we are trying to do. Basically, there are 2 types of share-based transactions I already told you. In the first example I told you, I am going to pay something at the end of the period by cash. The second story I told you, I am going to give you what? Shares. Those 2 types we recognize as equity settled share-based transaction and cash settled share-based transaction. At the end of the period, based on my share prices, I can give you cash, or based on my share prices, at the end of the period, I can give you equity or shares. Then if I pay by cash, I call it cash settled share-based transaction. If I give you equity, we call it equity settled share-based transaction. Understand? So we are going to learn how to account for those 2 types of share options. That's what basically we discuss inside IFRS 2. Now hopefully you can understand what we are trying to discuss. Different types of promises given by employers to senior employees to pay commission or to give equity or shares based on market price per share. How to account for that is discussed by what? IFRS 2 share-based transaction, but inherently there are some issues or small questions inside this. If you do so, I told you few now. There are certain estimates or degree of estimates are high in this case. Why? We need to estimate what will be the share price at the end of the period given by the employer. We are not sure about, and also I am not sure whether people will stay with me for next 5 years or 4 years. How can I know it? Even sometimes we sign a bond with you to retain you in my organization. Due to some reasons, you will leave the organization. So therefore, we have question in our mind. Same thing we discuss in human resource accounting also. When we discuss about the what is called future value approach, we estimate number of years people are staying with me or so in my organization, and we calculated the salary and took the present value as what? Human asset or human resource value. So then inherently I told you there are some problems in that method also. Here also same thing will come. Now let's see. Now stock options are very common practice for companies. Actually companies, the big companies or multinational companies do this because they need to retain skilled people in the organization, right? Skilled people, and also they need to attract good employees by giving this kind of package. If I ask you to work well to increase my performance, one side my company performance goes up, on the other side my share price goes up. Based on share price, you are allowed to get cash or shares. It's kind of two-way winning situation. Why? Employer will win. Why? Employees will contribute more as a result of this promise to achieve some kind of target. Therefore, company performance will be increased. It's kind of benefit for shareholders. On the other hand, employees have kind of benefit. Why? As a result of their high performance, it will be appreciated by the employer and will be given some benefit at the end of the period. Therefore, it's kind of win-win situation. Employees are having kind of benefit, also employers are having kind of benefit as a result of this kind of package. Therefore, this is kind of good strategic tool to motivate people or the key people in your organization. Look this example, simple one. Now actually content already done. Now the thing is we need to learn how to recognize that expense which is to be paid after a certain number of years over the service period, over the period people will work. That is only target we have. How to do that? Someone is? That it doesn't come to the screen. It's there, no? Someone has take over the presentation. That's the reason, I think. Now, okay, just see, refresh one. Can you view this slide in your screen? Okay. Why? You are not online. No, it's okay. Okay. No. Try something.